Hello, everybody. It is Michael here from My Retirement Trading, and I just got done interviewing CEO and founder of TappAlpha, Si Katara. And he was a pleasure to deal with on and off the screen. And we talked about TSPY and TDAC, and he broke everything down. So without further ado, let's get into it. Hello, everybody. It is Michael here from My Retirement Trading, and today we have a very special guest. But before I get into this, I must state that this is not financial advice or a recommendation, and it is for entertainment purposes only. Well, let's welcome today's guest, founder and CEO of TappAlpha, Si Katara. Welcome to the channel.
Michael, thank you so much for having me. It's great to be with you. I've seen a couple of your YouTube pieces and love it. Was hoping to meet you at some point, but really appreciate you having me on today.
Thank you for coming on the channel. So why don't you tell everybody a little bit about your background and how you founded TappAlpha?
Yeah, appreciate it. So for folks that don't know my story, I came from a totally different world. I was a computer engineer by trade, so kind of a coder. Went to work for a startup in Silicon Valley doing what they call embedded system software engineering, aka really nerdy, like hardcore coding. Loved it though. I love building things. And I was at a startup, so like sleeping under your desk, pushing for really tight deadlines, and really enjoyed that environment. Well, fast forward a couple years from there, that startup got bought by a big company, by Cisco Systems. And the big company was interesting, like you've got a lot more resources, but I love the energy of startups just because you feel like you can make a really big impact on the organization. So after that, I decided, okay, I got a little lucky. I have a little bit of capital. Let me try my hand. Let me start my very first technology company. So in 2005, I built and ran a company that was in a different world. It was construction technology, but built it from the ground up. Uh, did, fundraising, all that stuff. We built it to about 60, 65 employees, $10 million in recurring revenue. So it was a good sized business that was doing great. 17 years. And I blinked my eyes, man. It's like half my career was behind me. And I think the thing that really was a catalyst for me is that same time where I made the hard decision to leave the company that I founded. Part of it was we were about to have our first baby, our baby girl. And when you're having a child, it really sort of hones your decision making. And I didn't feel like this industry, construction technology, especially like, building roads and bridges and stuff, it wasn't the last chapter in my career, but I wasn't getting any younger. So I made the hard decision to leave. And this was October of 2022. I had always kind of been a buy and hold S&P 500 investor just because I was busy with the business. And it did really well for us. It grew and compounded over time. But in October 22, the markets were way down. And so if I was going to sell shares to make ends meet because I wasn't getting the steady paycheck anymore, I would have really hurt the portfolios. So I remembered a strategy. My dad, who was an engineer, also turned financial advisor, he taught me about covered calls, and I traded options 20 years. But the novel thing that just came out that same quarter was zero DTE options are now available. And I was like, the engineer in me was like, wow, that makes a lot of sense because you can be a lot more precise with the positions you take, which means you can probably manage risk a little bit more effectively. But I was like, the premiums are probably tiny. It's probably not worth it. So I tried it anyway. Fast forward 2 months, and just the options premiums on top of my SPY shares was covering the lion's share of our family's mortgage, which was a game changer for me at a time when we're about to have our first baby. So the hard part, though, was like we were talking off camera, it just takes a lot of time when you're doing this every single day. And I did a lot of math to figure out risk reward. So it took like 3 to 4 hours a day. And if I was working full time, there's no way I could have done it. But with the software background, wrote some tools that took 4 hours of work down to under 5 minutes. And that was kind of the aha moment where I was like, wait a minute, this is becoming such a big benefit for me, my family. It's alleviating so much financial stress. There's nothing on the market that's doing this. How can I, help other families like ours and package it and get it out to folks to use it too? So the original plan was to create a software where you could log in attach your brokerage account and have it run the TappAlpha sort of zero DTE covered call strategy on it. When you start going down the software road, there's just, especially for like retail investors, compliance is so hard. There's so much friction. So we were lucky to meet some folks out of New York that actually issued ETFs. And they were like, don't worry about the software. Like, if you just want to get this to market, wrap it inside of an ETF. You can do all the stuff that you're doing and then just deliver the output directly to people's brokerage accounts. And I'm so glad we did it because, one, it took all the friction out for people to just buy it on in your E-Trade account or Robinhood account. But the other thing, we were really adamant about how to construct the fund. It was really important to us to own real physical shares of SPY. And it was hard. The banks were pushing us in different directions. But when you do that construction, real shares inside of an ETF, a lot of the tax drawbacks, and again, I'm not an accountant, so do your own research, but a lot of the tax drawbacks to doing your own zero DTE option trading kind of get alleviated when you do it inside of an ETF. And so that's been a big benefit because now we're able to take these distributions for both TSPY and TDAC and get them out in a much more tax efficient way. So that's what we ended up doing. And then on August 15th of 2024, which was kind of like a beautiful like tribute to my dad, that was his birthday. We launched TSPY and have been running it ever since. And it's been growing, a huge part of the tailwind of the asset growth that we've had. We're a first-time fund, first-time issuer, and just launched our second fund. It's really hard to get more than 25 million in the first year. But getting past 50 and then getting to 100 in a little over a year was really a testament to the DIY investors, retail investors that have done research, understood what's under the hood through conversations like this, and actually supported it. And you can see where the performance of the fund has gone. But it's really a testament to the retail folks that have understood and used the funds to really help their portfolio. So it's been an amazing ride so far. Loving the people that I'm meeting and the experience that we're having, but it's very different than that where I started my career.
So, T-Spy is your first fund. Can you break it down for the audience?
Yeah. So TSPY is very simple. It owns essentially dollar for dollar. I think we're 99.6% of the fund assets own real shares of SPY. And the rest is just cash to help manage it. And then every day we're writing out of the money zero DTE covered calls to harvest little bits of option premiums, add it up, and then that's what we end up distributing on a monthly basis. So we're getting S&P 500 exposure through the SPY, and then the options piece is helping us create the sort of SPY with the paycheck so that you can get a monthly distribution. And we're distributing about 14% annualized distribution number, as well as getting sort of the S&P 500 exposure. And that was the balance that I wanted. When I first was doing this, I loved the S&P. It was like, that's the bar that every hedge fund and every fund manager is measured against. And they're like, 88% of fund managers don't beat it. So I'm like, well, not smart enough to be a stock picker. So why don't I just buy that? But I am smart enough to figure out how to kind of systematically find ways to create value added on top of that. And that's what we built. And it seems like it's helping a lot of folks as well out in the market. So it's been a lot of fun.
So, you got about $100 million. I mean, under assets under management right now in T-Spy, right?
Yeah, it's about 114 now, I think. So it's continuing to grow, which is really fun to watch.
Yeah, congratulations. Um,
Thank you.
and then you got a sister fund that just came out on September 4th, 2025.
Yeah, the little sister is about a month old, a little over a month old. Actually 6 weeks now, 6 or 7. But it's funny because the reason I'm laughing is because I just had a baby girl as well, who's a younger sister to the daughter that I had when we first launched TSPY. So I'm just making the connection now. But Sister Fund is up and running. I think we're at about 20 million in assets in 6 or 7 weeks, which I don't remember how long it took us to get to 20 million in assets with TSPY. It took us maybe 6 months. And so that's up and running now. I think the coolest part about T-Dac, which is essentially the exact same strategy as T-SPY, but just takes S&P 500 out, plug in Nasdaq 100, and that's the same sort of option strategy on top. But everything we learned in deploying TSPY and continue to learn, we've codified that into the underlying fintech that helps us run the strategy. And on day one for T-Dac, we were able to apply that and run it and create sort of the options value that we had for TSPY, but now on the Qs. So been a lot of fun, and I love it because as an engineer, I love to solve problems once and kind of use them everywhere. And it's been a good test run over the first 6-7 weeks to see how it's.
So tell the audience what your first payments rate of return was on TDAC,
Uh, as far as the distribution.
right?
Yeah, so what one thing that's really cool is that like the Nasdaq 100, it has a little bit higher implied volatility. So what does that mean? It means that there's a little bit more option premium to go out and harvest. So while TSPY is distributing about 14% annualized, we just did our very first distribution for TDAC, and our number landed at about 17.4% based on the premiums that we're able to sort of harvest. So that's about the relative relationship between implied volatility for the SPY versus implied volatility for the Qs. So it's working nicely out of the gate.
Well, just to be transparent, I am an investor in TSPY and TDAC. Um, so just wanted to be transparent there. You want to go into the zero DTE strategy a little bit more?
Yeah, it was so when we were building this thing, trying to figure out how to implement what option tools to use. And I did the study, so like got a ton of data and did the comparison. If I built TSPY with a 30-day option, so you write one call over a month, what you get, and then the zero DTE just to see what the comparison was. And there were three big benefits to zero DTE. The first one was really surprising, but it makes a huge difference. If you took a 25 delta call, so just pick a static risk level, and you wrote a 30-day call and you get X dollars in premium. If you did the same thing, 25 delta call, same risk, every day for the 22 trading days over that month and added it up, you would end up with 4 to 4.5 times the option premium potential. Just that alone, when you think about risk adjusted returns, is so much better. And I was trying to figure out why is that? Why is it such a difference? And there are two reasons. The first is for anybody that like looks at an option graph, there's this thing called theta decay, and that's the time value of the option, and it's the steepest like on the last day of expiry. And so you're taking advantage of the steepest part of the slope, but if you're selling the option, that's exactly what you want to do. And so zero DTE enables you to take advantage of the steepest part of the theta decay. The other part is zero DTE options are wildly popular now. They're more than 50% of the option volume that's traded on the S&P 500 as of, I think, New Year's this year. So those things are like, oh, okay, that makes sense. But it is a big difference by using zero DTE, and it makes up for the transaction cost because you're doing it every day. The 4X, really makes it, I think, a good choice for these strategies. The second thing, and last night was a great example, we're true zero DTE, meaning we're only have an open call for the 6.5 hours of the trading day on most days. So what do we get to avoid? All the overnight risk. And so like when there's earnings calls after hours, we're good because the S&P 500 will pick it up on our long position, and you don't have to worry about managing the risks of the short. And so that has been a big benefit. And like last night, the market was up a percent and some change. We didn't have to worry about managing our option position because we were risk off for the option. So we caught all the upside with the long, and then we put our position on after the market had absorbed the news about the trade deals and stuff that are going on with China. And then the third thing that is also really helpful is with the 30-day call, you get kind of one swing to sort of pick your strike. But with the 30-day, you get 22 at bats. And the analogy I use is if you're flying from New York to LA, and you take off and you point your plane directly at the LAX airport, but then a gust of wind comes or a thunderstorm and throws you off track, you don't have any power to adjust. Versus with a 0-day strategy, you get 22 chances to sort of adjust your trajectory, which just gives you a much higher probability that you're going to land where you intended. And so those three things put together made it a really powerful strategy, and it's worked really well for TSPY, and so far it's working really well for T-Dac. But those are the key reasons why we chose short dated versus anything long.
Recently did a video on T-Dac on my channel, and I compared it to some of your competitors and the S&P 500 and the underlying, and in the short amount of data so far, it showed T-Dac actually ahead, actually beating the underlying. So I was really impressed with that. So
Been a good start for sure. And I think it's all dependent on the market conditions underneath. But since we started September 4th, the market has been an ideal environment for us to capture the growth of the queues and add some additional income with the option premium. Who knows? There's no guarantee for what happens in the future, but so far it's working as designed out of the gate.
so these funds seem to like have a very, very stable NAV to them. What do you think the NAV stability on these funds?
I think it comes down to, I mean, it's two things. One, it's market performance. What's the underlying doing? And then two, what's the option strategy doing? And are you getting capped out or not? Or are there big sort of swells in the movement of the market? Over the first year of TSPY, if you look at the history of it, when April kind of came, there was a big drop in the market. And so, of course, TSPY owning so much of SPY absorbed a lot of that. We just had a little cushion with the option premiums that we're able to add on top. But in the long term, the NAV like philosophy is, our fund family is it's growth plus income. And we want to take a balanced approach without doing too much of a trade-off for one or the other. So our goal has always been, hey, let the nest egg that's invested like continue to grow, but people need, income, income for today and growth for tomorrow is the idea. And so we try to really take a balanced approach that we're not going to over distribute income at the expense of shrinking the nest egg that's been invested in the first place. And that's a core, I think, philosophical thing that we try to deliver. You can't guarantee anything because markets are uncertain, but that's really our goal for the things that we can control. We want to create a really balanced set of funds that allows people who have long time around. I mean, it's kind of selfish because I'm obviously a big investor in TSPY and TDAC. I wanted that product. It just didn't exist in the market. And we just want to make sure that, with the time horizon that we have, I'm late 40s, young family, but I need income in order to operate. But I don't want that core nest egg to shrink. I want it to grow over time. And then when it grows over time, the income that it can actually generate grows with it. And so that's really what we're trying to deliver to the market. We're doing our best to stick.
Yeah, I like that. What is your thought on drip?
So drip is actually really helpful. And the way I think about it is if you don't need the income, like don't take it and tuck it right back in. One of the things I mentioned, the potential tax efficiency in doing TSPY the way we did on T-Dac, the distributions, at least the 2024, how everything was classified last year's, was very tax efficient. And so we were like, okay, there's two groups of humans that we want to try and benefit. One, there's retail folks and folks that need the income. So you need to put a higher distribution on. But there's also a group of like advisors or retail folks that don't need all the income today and they want lower distributions or no distribution. So what we landed on 14% as kind of the target that we're shooting for. But if we do it tax efficiently, if you don't need all 14, let's say you need 8, you can tuck the other 6 back in without having a leaky bucket from a tax perspective. So that's how we sort of checked the boxes for multiple audiences that may want more or less distribution. So for drip, you don't need the income, don't take it, tuck it in, and that's just going to help you compound growth of the S&P over time. And because of the way that the fund has been structured, we've been pretty good from a tax efficiency standpoint, so you don't leak resources out in that process.
So, uh, what do you think would happen if somebody was retired and they needed the money and they just took all the distribution?
Yeah, I think so. That's where you sort of get the NAV question of like NAV erosion and wanting growth. If like for last year, for example, I think or over the last year, year one for T-SPY, I think the S&P did 17% and we were around that. And then we distributed 14. So you actually had some NAV growth as well as the distribution. So you could take all 14 and then you still had 3% in the nest egg there. If you didn't need it, you tuck it back in, you've got more growth to compound. But if you did, you're still growing your nest egg. So at least year one, it helps the retirees that need it to live off of, because we really want to try and sustain that original nest egg.
So we talked about tax efficiency and the return of capital. You have any new products that you can talk about coming out?
Well, so it's interesting from a compliance standpoint. We can't really talk about them until they're what you call SEC effective. But there are some new stuff that we've registered for, and people can probably readily find it in the SEC logs for the registrations that have happened. But we're really excited. One of the most important things for us is taking feedback from investors, from advisors on, like, what do you need? What are the problems you're trying to solve? And so we've heard a couple really interesting pieces of feedback. One, higher distributions, people need because they need income now. If people have a longer time horizon, people are talking about, well, what if you had some light leverage? And then we also hear, instead of monthly distributions, can you do weekly? And so if you could package all that stuff up in a way that still sticks to our core values of wanting your nest egg to grow, giving reasonable amounts of distributions, and not going overboard in one direction with leverage, maybe we can put together a balanced product that could fill a gap that's in the market today. So can't speak directly to products that we have, but anyway, research can be done. And I think what's really fun for me too, it's the same idea of, like, we have this platform that's doing what it's doing, and it's delivering effective outcomes. How do we take it and help more people, achieve the goals that they have? And so we're really trying to get creative in ways to do that.
Yeah, I'm looking forward to seeing your new products as they come out. Definitely. Do you have anything you'd like to tell the audience on closing?
Just, I mean, I really love these conversations because folks like you, and there's, I think, a good network of people that are talking about the covered call space and the income space and ETFs. But it's just so important to open the hood and look in the box of what's in the ETF, so you understand there's no right or wrong in the industry. It's just a matter of what's a fit for you. And the more transparency and the more education and the more conversations like this that can be had, the more people can have really the decision frameworks to make decisions that are best for themselves and their family. I think that's the most important piece, is you're getting into this, like, for me, like, the fact that you mentioned that you're an investor, it means everything to me to have people that have confidence in us to deliver the outcome. And part of the hope is, like, we want to be really open with everything that we do, because this is your hard-earned resources that you're leveraging the funds to help deliver outcomes that you're hoping to achieve. And so the more education, the more transparency, the more conversations like this, the better. And you being able to, like, translate some of the stuff that are in the funds out to your viewers is such a value add, so people can at least have the information they need to make the best decisions for themselves. So I appreciate it. It's such an important piece of what we want to do. It's, we want to provide access not only to products, but really more importantly to financial education. It's so important. And I think there's a lot of improvements that can be made even in our schooling systems to help give people the tools that they need to make good financial decisions. So the stuff you do is I'm really passionate about. I love to see that you're having the conversations, and excited to hopefully continue and maybe come on again and talk about future products. Just crack open the hood, look underneath before investing any dollars, because that's going to be the thing that really will help you reach the goals that you need to reach.
Yeah, I really enjoyed this interview, and I would definitely like to have you back when you have new products come out. And like I said, I appreciate your time for myself and the viewers. So thank you for coming on to the channel.
Thanks for having me. Enjoyed it.
All right, everybody, take it easy.